Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at probably one of the best stocks that we have so far to date, and that is Microsoft, ticker MSFT. Right here we have the scorecard for the company, and things look great across the board aside from the value. It does look like it's a little overvalued at the current price, but it's almost to be expected with the stock. So we're coming up with a margin of safety of 10%. We'd be looking at getting into the stock around 240, fair value 270, discounted cash flows 270, high. So you'd want to reevaluate around 316, but with a stock like this, even higher. Currently, the stock sits at 312. It's reached as high as 366 and as low as 213. So earlier on in the year, it was at a very good price, and I mean it's up $100 from there, so it's up 30% from that point. But that would have been a great time to buy in. Right now, we're looking for it to drop back down to at least 270 because that's both the fair value and the discounted cash flows. Ideally, 250 below. So earnings, we're getting an earnings yield of 4%. Again, that's showing the valuation is a little high. We want that to be closer to 5. So at the current price, that'd be something around $15.61 per share, which we're not even looking at until probably at least 2025. If we move that down to the low for the year, 1067, that was a little lower than what's expected for this year. So definitely showing that the real value we want to get in, it's a little high at the moment. Cash flow yield, very strong, 28.07%. The average is 31.48, so it is a little bit lower than usual. Nothing to be too worried about, especially since they spent $68.7 billion on the acquisition of Activision Blizzard, and they have gone crazy with acquisitions. They've acquired 213 companies in the last year, 39, and the largest, of course, being that recent Activision Blizzard acquisition. Dividend yield, they're not huge on dividend yield or payout ratio, so they have a lot of room to grow if that's the route that they want to go. But considering the ROE, ROI, ROA, the returns that the company gets on their money, it's better used by them rather than the investors. So they really should not focus too much on that dividend and just continue with growth if they really want to drive value to investors. ROE 35%, debt to equity is right at 1. They've been driving that down, so it's at the perfect point right now. And going forward, it should move in the correct direction. ROI 17.66. So for every dollar that they are able to invest into the company, they're getting back 17.5 cents. ROA, essentially the same thing, just the assets. When they're actually buying assets, they're getting basically the same return. We already touched on the debt to equity. They have some room to grow their debt if they really wanted to. Gross margins of almost 69%, up just slightly from what it's historically been, 68.5%. Net margins 34%, down a bit from the historical 34.5%, but again, that's nothing major. Then we have the 3-year, 2-year growth, some analyst projections, and then we have a little forecast ourselves this time. So they've been growing their revenue at amazing rates, double digits, 14 and 12. Analysts are projecting 11 and 12. So I'm saying over here, let's say only 11% growth. They come in a little bit lower than expected, kind of on below track too from what they've performed previously. Earnings per share growth, we're looking at 18.64, 9.41, and then analysts in the future are projecting 13 and 14% growth. Cash flows, they've slowed down on their growth more recently. It could be that lower number that we are seeing, 28.1% that they came in with last year, and they've been in the 30s historically. That acquisition kind of just a blip on that, so I wouldn't be surprised if that hops back up and gets back to around 30% cash flow yield. The share count, they're buying back more than 0.5% a year. Assets, they're growing double digits, right around 11%. Liabilities are growing right around 3.5%, 4%, but that's nothing major. In fact, more recently, that's inflation. So not a huge concern, especially since their assets are growing a whole lot faster. And their dividend, they're growing it right around 10%, maybe a bit more than that. So projecting out, if we're looking at 11% revenue growth, buying back 0.5% of shares, assets 10, liabilities 4, and a dividend growth rate of 10%. At today's price, I don't think you're going to see much return over the next 3 years if they're able to come in with that, at least based on the fair value of the stock. There's a huge premium that goes into it because the company that it is, if they do acquisitions and other stuff. So this is maybe more of a lower end estimate, but if you're buying the stock today, I wouldn't bank on too much growth over the next 3 years. And then over the next 5 years, you'd be looking at something more in the realm of 22% over that time period. So again, that's not incredible, considering that we're looking for 8 to 10% in the market. But if we adjust this, and rather than buying at today's prices, we say, what if we go to today's fair value? You'd be looking at a 12% return over the next 3 years and a 36% return over the next 5 years. So this is going to be a game of patience. It's clearly a great company. Everything looks great, and the market recognizes that. So it's trading at a premium. But within the last year, it's traded below even our margin of safety. So that would have been a great time to scoop up, and that's what you need to watch out for, is set your buy price and wait for the stock to hit it. I mean, we could look at everything, but it's such a great company that we already know the story here. Like, everything looks incredible across the board. Cash flows, there's a little bit of a blip 2022, straight back up going forward as long as they can hit that 30%. Dividends, great consistent growth. Everything just up and to the left. And it's definitely a stock that's going to be on my watch list. I wish the shares were cheaper so I could sell puts and try and collect some premium. You know, right now, a $250 put can fetch $41 in premium a month out, but that'd be $25,000 in collateral, and that'd be too much of my portfolio that I'm putting into a single position. So I'll wait. I'll be patient. I'll do some trades, probably some call credit spreads, looking for some movement to the downside, and then buy some shares off of the premiums that I collect from there. And that's what we're looking at on this stock. So for now, it is the best stock that we've looked at. It's definitely top of my list, has my attention, just not at a good value point as of today. So we'll keep an eye on it. We'll definitely follow up with earnings and see what happens with the stock. I'll set an alert and I'll let you guys know once it hits my buy price. But I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other stocks that we should look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.